here. This is show number 589.
Wow.
And today we're actually going to replay a topic in a video that we did, I believe a few months ago that had a ton of views on the subject of reverse mortgages. Sorry. And so this will be a tool for real estate agents and mortgage agents out there to kind of service the clientele and the prospects that are, a good demographic here at the Las Vegas Valley here. So, but before we dive into that video, Ruth, what is happening in real estate?
Well, it's a hot market, that's for sure, in this hot month of July. We listed over 190 homes, and that pushed that was one day, that was Friday, and that pushed our days of inventory to 24, 23.9. So 24 days of inventory, and we haven't hit that high of a number in a couple months.
Right.
And, yeah. And the good news is, we have over 1,000 homes under $400,000 on the market, and it churns. So there's a lot of new homes to look at out there, and people are not going too high above the list price like they were. So that's helping the nerves of the buyers and the buyers agents, because it's very nerve-wracking.
Definitely. And a lot of work too. That's, for both parties.
Yes.
Both the selling agent and the buying agent, having to put in multiple offers.
Right. Well, the price point is up to a median of $398,000, the highest it's ever been. And I hope it doesn't go to 400. That's my hope. And I think it's coming down a little bit. I kind of watch the stats, every weekend. I make sure that the median isn't creeping up there. So hopefully it stays there. We are selling a lot of $1 million homes.
Sure.
We're selling 4.5 a day. So
wow.
Yeah. And last year we were doing 1.5. So, that's a big jump in the $1 million home market. And that just makes our economy more solid here. Don't you think that's true?
I think it diversifies a little bit of the demographic that's moving here. And the people who are buying $1 million homes could be potentially business owners, right? And that's the promising thing is that they could bring companies here and talent. And that's really been kind of I guess, the decelerator on the growth of Las Vegas is the not enough qualified, technically skilled workforce.
Right.
But, once more of these, top end executives and owners and, start bringing their companies here, they're going to attract and bring their workers. And hopefully we can build an infrastructure around education and things of that nature to support that and flourish that ongoing. So, I mean, the horizon here for Las Vegas is very promising here. I mean, 65,000 in Garth Brooks sold out concert last Saturday. And I think I just read an article that the major soccer final is going to be held here at Allegiant Stadium as well. So, and the A's are still looking around to see if, this could be a market for them. So, I mean, a lot of things are happening.
Yes.
And, kudos to the home builders this time around. They didn't overextend themselves, and they're kind of keeping the easy flow of new home builds. And so if anyone's waiting for the 2008 crash in real estate market, probably not this time around, because we're not experiencing the same type of dynamics that we saw during that period of time. And right now, I mean, mortgage rates just went down again. I mean, we're looking at 30-year fixed mortgages. I was looking on Yahoo Finance here. I mean, the average rates with maybe 1 point is 2.5%. And that means at par is probably going to be 2.875 or 3% again.
Wow.
And so, and Jerome Powell this week, and I think, he sat in front of Congress this week again. And he said he's not going to raise their interest rates till 2023. I mean, that's the message he's been sending out for, the last year, and he's holding true to that. And so, that's going to continue to drive demand is this low interest rate. And so at least they'll keep it stable. And at one point, could we see a 10%, 20%, maybe reduction in price here? Absolutely. But nowhere near close to 50, 60% that we saw until 2008. So,
right. Well, everything I read, and everybody says this economy is so solid. I mean, the stimulus put money into the economy. And I think people don't realize that. Yes, it raised the debt. And I'm not an economist. I don't know how the debt plays into the stimulus, how that, I think you have a better explanation of that than I do, because I don't study that.
Right. No, I mean, that's how we saved off like disaster last year. We can shut down an entire economy and we can come out even stronger because, $7 extra trillion of money from thin air for the federal government injected into the economy and giving stimulus checks to everybody end up working out. I think Ben Bernanke kind of set the tone after the financial crisis. He was the federal chairman right before actually Janet Yellen and now Jerome Powell. So they took the playbook of what they did out of the financial crisis and kind of accelerated in a much more condensed, because Bernanke didn't print. He printed 4 trillion in like 3-4 years, and Jerome Powell printed 7 trillion last year in 8 months. But the good news for us is our trade partners around the world are also running on a central banking system that's reliant on fiat currency and the printing of money. And our largest trade partner, China, artificially devalues their currency to maintain the hold on manufacturing across the world. So we're not too concerned. I mean, the strength of our dollar has remained pretty strong through all this money printing. It's because and it's because everybody else is printing money, and so we don't have to be too concerned about hyperinflation. Hyperinflation is going to happen when our trade partners are going to demand more dollars for the same goods and services, not necessarily supply and demand. I mean, we have a fixed amount of people that's growing and a fixed amount of products and services that we can provide. I mean, that's going to be high right now because of the supply chain issues that are happening around the world and the operation of manufacturing, distribution. There's still ports. I actually was in Huntington Beach 2 weeks ago for 4th of July weekend, and we were at the beach, and you could clearly see shipping containers on the coast still parked out there waiting to be docked and unloaded. So they're still not running. The docks aren't running at 100% either. But that's going to all go away eventually when everybody gets back to work 100%.
Yeah.
And
I heard the stock market had a 3-week run, all-time highs.
Yeah, stock market hit all-time highs. I think the end of last week, and then this week it's kind of settled down a little bit. But yeah. I mean, there's just too much money out there. I think the U.S. bank, or according to the St. Louis Federal Reserve, I mean, there's like $17 trillion in cash deposits at commercial banks right now.
Oh my gosh. Oh.
$17 trillion. I mean, so there's plenty of cash out there. And that's why we have these hedge funds looking at, building these real estate investment funds, private funds to buy up apartments and houses for rent, not for flipping, but for rents right now, because they realize that the dynamics of, the home prices going up is we're going to probably create a generation of renters for probably the next decade here, especially with the transient nature and the ability for workers to move remotely. Maybe people don't want to settle down in just one place because, you can open up opportunity if you're mobile across the country, maybe even across the world. And, the idea of working remotely in like Hawaii or, Fiji or, whatever one of these exotic places, and then feel like you're on vacation all the time, so that's going to be a possibility. And that means people are going to be more opted to rent if they have that mentality, because they'll move every 2-3 years or 1 or 2 years. And it doesn't make a whole lot of sense if you're, going to move 1 to 2 years to buy a house, because you don't know, where prices are, and the cost obviously of acquiring and maintaining a house could eat away at the, your cash flow there. So, I mean, a lot of changes happening. I think it's all good though. The dynamics of what's happening around the world, we're going to shift. We're going through a major shift right now. This feels like 1999, 2000, when the .com kind of started taking off. There's going to be some companies that jockey around and this whole crypto craze and digital currency, and it's all disrupting what we think is what should be done historically. And we're going to rethink. Businesses are going to rethink a lot of things over the next 2-3 years, and the ones that figure out, well, will do well, and the ones that don't will, go away and become Blockbuster. So
yeah. Well, it's interesting because it feels like the economy when Clinton and Gingrich balanced the budget. The economy back then felt so strong, and it kind of feels like that, even though the budget isn't balanced. But I'm sure there's other economic factors that are making, like you said, 17 trillion in commercial banks is incredible. So, yeah. I know people make off the wall comments. Oh, we're going to have a crash. I'm not buying well, good luck with that.
Good luck with that.
Yeah.
It might be well. I mean, you're going to eventually be right. But whether it's 2 years from now or 10 years from now, right? It's a lot of time.
Yeah, there'll be a devaluation, like you said, probably, but it will be minor. And we're not set up for a crash or a bubble. We're just too solid.
Not here, especially not here in Vegas. I mean, we don't have the same type of speculation that we had in 08, 07, 08. You and I don't own 5 homes right now at 100% financing. It's just right. So and rents are high, and they'll remain high. They're not going down.
No.
Right. And so cash flow, I mean, like I'll give you an example. Like if you buy, a $400,000 house right now, I mean, your mortgage is probably going to be anywhere between 1,800, right?
Yep.
But as an investor, if you have enough money, put 20% down, I mean, then your mortgage becomes 320, right? So now it's like 1,300,
right?
And you can rent that house because that house is probably going to be like almost 2,000 square feet, 1,600, 2,000 square feet, right around there, right?
Yep.
You're renting that house for 2,100, 2,300 right now.
Yeah.
In the Vegas market, which is crazy. It blows my mind right now, but you're cash flowing at that pace, given the rate that we're going right now. And so.
Absolutely. Yeah. And I think Vegas has 50% renters. 50%
is that the number? Okay. Wow.
Yeah. So it's quite a place for investors here.
Right. So, yeah, I mean, the prospects and horizon for Vegas is very strong here. So more and more people actually are coming here to look at the rental. I have some friends that are like, now I'm like, wait a minute, maybe Vegas is a viable place. Because after the financial crisis, everybody got scared of Vegas because, this is a boom and bust town. But there's things changing right here. More industries moving here, and more things like a big football stadium has been built, and so I mean there's a lot of investment happening right now. Yeah. So, any other thoughts?
No, that was it. That's it for me today. I know the reverse mortgage situation. Like you said, I mean, 30% of the people here are retired, and a large percentage of them own their homes. Some of them free and clear, and you can do a reverse mortgage and get cash out, especially if you don't have anybody that you're going to leave your house to, spend the money now.
Right. Yeah. I mean, there's people who own their house free and clear who upgraded in this last year, and instead of putting a mortgage or instead of, putting all their money into their house and still having, a small mortgage and a payment, they've just done the reverse mortgage. So, I mean, I know, a family that I think 5 years ago or 4 years ago did a reverse mortgage. And, the scare of reverse mortgages is like, what if home prices have gone down, right? I mean, that's the scare. But this video that we're about to play will address that. But what if home prices go up? Which they've done in the last 5 years. And, now you don't have a mortgage and you get an income stream from that cash.
Well, the thing that I think people don't realize is when you get a reverse mortgage, you don't have a mortgage payment.
No, zero mortgage. You can get paid from that mortgage.
Yes.
You're basically taking money out of your own principal.
Depending on your situation and the value of your home, it's like getting a HELOC but not having to pay it back.
Exactly right.
Yeah. And as the values go up, you can actually draw more out of the home. Or you can just take it in a lump sum.
Right.
Yeah. So lots of things about reverse mortgages, and they're now like the company AGG, the one that we're going to watch today, very safe, very solid. And I was shied away from recommending them years ago, but now that they've changed their guidelines and everything, I don't see any loopholes where you can get hurt.
Yeah, absolutely. So another tool to put in your toolbox to talk to your clients, because 30% of, homeowners are in their retirement ages here in Las Vegas, big demographic. And it's just another tool for you to offer, your professionalism and service that can differentiate you from the rest of the crowd here. So anything else before we play the video?
We have a LinkedIn and a Google business page class on July 22nd from 10 to 1, and go to be.vegas to sign up for it. I'm going to start advertising it this weekend, and we're taking a limited number of people in there because we show people how to do things. And if there's too many people, the class the faster people, the slower people get lots of help, and the faster people get discouraged. So we have to monitor the number there, but it's a great class. And right now, our last couple of classes, most people have learned how to cut and paste and do things like that. So,
right.
So yeah. All right. So we can get started with the video, and I will see you next week, Max.
Yes. And we'll see everybody next Saturday for the live show.
Yes.
Once again.
Okay, here we go. Good morning, everybody, and we are getting ready for our Saturday show. And we're waiting for our moderator, Max. He'll be here shortly. And I want to introduce our guest today. We have Susan Liberty, and we have Ryan Ponsford, and they're with the, who are you with, Susan? Want to tell
American Advisors Group.
And what do they do?
We do reverse mortgages primarily. We also do traditional forward mortgages.
And what about you, Ryan?
Similar. I support the team. My background's in financial services and planning for about 25 years. And so I partner with Susan and other professionals at our firm, working with more strategic cases and more affluent clients on how home equity can create better retirement outcomes.
And Max is back.
Yes, we're back. Welcome, everybody. Thank you for being a little patient this morning with our technical difficulties. Welcome to the Saturday morning real estate marketing show with Ruthie Rocks, Ruth Allbrand, and I am Marketing Max. Ruth, what show is this?
This is show 506, Max.
506. And today, first time topic, first time guest on the show as well. We have Ryan Ponsford and Susan Law Liberty from the American Advisors Group. And they're on the show to talk about actually a very important topic, especially here in Las Vegas with the demographic that we have here of homeowners in the Valley, the reverse mortgages. So we're going to hear some interesting facts and kind of key elements of the reverse mortgage.
Hi, Tom, my favorite character.
Ryan, right? Oh, Tom.
I'm talking about Tom Selleck.
Yes,
Tom in the background. Yep.
Yes, behind Susan Law Liberty is Tom Selleck. Let's start with that first, Susan. So let me introduce them again. Both Ryan and Susan are with American Advisors Group. They're on the show to talk about reverse mortgages today. But let's start with that. That was the first thing I saw. I was like, I didn't know if that was Ruth's kind of other kind of monogram that she puts on the show. But tell us a little bit about why Tom Selleck is behind you.
Well, Tom Selleck is our spokesperson. He's on all of our commercials for AAG. I'm sure a lot of people recognize, they kind of associate the two names together. Okay. So he's in a lot of my Zoom meetings with me and goes to a lot of my real estate meetings with me as well.
Oh, fantastic.
But he is our spokesperson for American Advisors Group, yes.
Have you met him in person?
Yeah.
Have you met him in person, is what Ruth asked.
I have not. I'm fairly new to the company. I started back in August, have never looked back. It's a great company, very good morals and values, but I have talked to a lot of other loan officers and just people throughout the company that have met him. he comes to a lot of the functions, from what I understand as well. So a lot of people have met him. I don't know if Ryan has or not, but a lot of my fellow colleagues, loan officers, have met him in person. So he's a great person from what I understand. Yeah.
Right. Ryan, have you met him?
No, not in person.
No. Okay, got it.
I always, when I'm around, I like to ask people if Tom Selleck is a Magnum PI or Blue Bloods. Which one is he to use? For me, it was always Magnum. But
Of course, Magnum PI. Come on.
308 Ferrari was my dream car.
Right, exactly, red Ferrari.
Cool.
He's driving under the truck. Yes.
Yeah, exactly.
That's the scene. All right. I always like to ask this first question, and this is to you, Susan, first, then Ryan, you can chime in here. Are Las Vegas native, or you transplant from somewhere else? How long you've been in Vegas?
Myself?
Yes.
Yeah. So, I've been here. I'm probably going to give away my age a little bit. I've been here since 1968.
Wow.
So
Okay.
my dad was military police, and that's what brought us to Las Vegas. We lived out at the Nellis Air Force Base for many years. And my dad retired from the military, went into the Marshal Service. He was a U.S. Marshal. So we stayed here in the Las Vegas area, and I grew up here.
Yeah, that was pretty much a native.
A lot of
pretty
changes.
much. Yeah. You've seen, yes. You've seen.
Yeah.
Were you here when part of the strip was still dirt roads? As far as that's so crazy.
Yeah,
Well,
I really wish I would have, been more forward thinking and taking more pictures and keeping all of that stuff. It was, yeah. And I worked at the Sands Hotel 100 years ago, before they blew that up. And, I worked in human resources at the time and did orientations for new employees. And we would put together little slideshows of, what the strip used to be and the pictures that we used to come across and, the Rat Pack and what we had access to. It was just amazing. So I wish I could have had some of those pictures today.
Yeah, I wonder where they're archived right now. That'd be great.
I know.
Especially with all this digital art that's going on. I'm sure if someone put a montage together of the history of Las Vegas and the evolution over the decades, so great.
Yeah.
How about you, Ryan?
So I'm actually in Southern California. I live in San Diego. So my ties to Vegas are back in college. We used to go there quarterly and make our contributions to the building the casinos and then come home.
Fantastic. Well, welcome virtually to Las Vegas. Thank you for coming on today. So Ruth's been wanting to have this show about this topic for quite a long time, obviously because of our demographic group here in Las Vegas, with the senior citizens and the retirees in the Sun City area and them having a lot of equity in their home. What has been the appetite for reverse mortgages? First, let's start before I ask that question. What is a reverse mortgage? And tell us a little bit more of the details of what that is and why people even want one.
Do you want to answer that, Ryan, or do you want me to?
I can. Yeah, short version is it's basically a loan. The thing that makes it different than a traditional loan, that there are quite a few unique features, but the thing that people most notice is you have the option of whether or not to make payments. How often, if you make them at all. Most people set them up where they don't plan on making payments. So your payment flexibility is far greater than what you get on a traditional mortgage. A lot of people know you can make payments on them, so they can be structured like a traditional mortgage. You can have them with a line of credit, which adds some really interesting features. It's a revolving line that you can draw from. And so, it's fast. I come from the financial planning space, and I never knew what these were. When they reached out to me to ask me about them and see if I wanted to get involved, my first response was absolutely not. I thought they were a scam, that took advantage of people.
Mm-hmm,
and as I started doing the math, I was blown away by how these work, both in the purchase market, in the refinance market. And it's really been mind blowing. So I've been meeting now I've probably been in front of several thousand financial professionals and real estate agents. And I can honestly say in the last couple of years, probably less than 10 have truly understood how this thing works.
Sure.
So there's just a lot of not either bad information or wrong information out there. So it's fun to be able to, people like Ruth that say, hey, let's get the right information out there. This matters. People need to hear the accurate stuff. And so it's fun to be able to share some of it.
Yeah, yeah, okay, perfect. Yeah, there's a lot of confusion around it because it's a lot of moving parts, and we're traditionally taught to pay a mortgage, not to, get paid from a mortgage or have flexible
Right.
payments. And anytime anyone hears flexible payments now, the 2008 crisis kind of scares a lot of people about flexible payments and how that can balloon on them at one point or another. So we'll go into details. So have you seen, obviously the Vegas market, good demographic for the reverse mortgage product here? I mean, what's been the response? What's been the appetite for this type of product here in the Valley?
Yeah, so there's been, I started last August with AAG, and the response has just been great. I mean, with the low rates and the high equity, that could, that is the perfect storm for a reverse mortgage. The higher the equity, the lower the rate, the more they are going to get for a reverse mortgage loan. So, of course, it's age driven as well. But yeah, that is the perfect storm. So when they're living in their home, of course, on a purchase, it just really depends on purchase price and rates again. So again, rates have been at an all-time low. So it's just been a perfect opportunity. I was just amazed at how many people, through this whole epidemic were wanting a reverse mortgage. Mm-hmm. But again, I think people were doing a little bit of panicking too. What does the future hold? What's going to happen? People were losing their jobs. There were still seniors that were working and were being laid off as well. I've got seniors, I'm working with a gal right now that's 76 years old, and she's like, I'm tired, I want to retire. So, we still have a big part of our senior market that are still working. She's working full time. So, it's a great product to help those, to supplement, to get rid of their full-time jobs. But yeah, it's just a perfect storm right now with equity high and rates are still low.
Okay. So, I mean, you kind of mentioned it just briefly there, Susan, on why can you expand a little bit on the different scenarios and why someone would even seek a reverse mortgage? Yeah.
So, many different reasons why, as I just explained with, wanting to either get rid of a job, supplement an income, or purely just, for a little bit of fun money. Some people want to, and Ryan will get into this more too, is to just, instead of using their portfolio to live off of, they're going to use the equity in their house that is just sitting there not doing anything for them.
Right.
And again, he'll get more into that, but there's many, many reasons why. Everybody has their own story. I hear a lot of different stories, but mostly to supplement income, I would say. Because people have not planned properly. But that's not the only reason. And again, I'm hearing more and more, people that have money. I'm working with a couple of people right now that have, not multi-million, but a couple of $1 million in their portfolio. But they want to, but then they've got these houses sitting there that are doing nothing for them, $800,000-$900,000 houses that are paid for, that are just not earning any interest whatsoever for them. So they're like getting more smart about it. Like Ryan said, we're educating the financial advisors. So that direction is a whole different direction. Some people a lot of people, I think now with the pandemic and not wanting to go into healthcare or in-home facilities to age, they want to stay at home.
Mm-hmm.
So we're working with more in-home care providers to come in and age at home. So they're using the equity in their homes to stay at home and age. They don't want to go to retirement communities. They want to stay at home. So that we're seeing more and more too.
Yeah, that definitely is probably something that everybody's thinking about these days.
Yeah.
From a home care perspective and the nursing home with the debacle that happened last year. So that's a key point because a lot of people who have a ton of equity, that's just dead equity, and they don't want to necessarily sell. They maybe want to tap into that, and they don't necessarily want to do a complete cash out refinance and then have a payment either. So that leads me to my next question is, can you do a cash out refinance for a portion and take some of the money? Say, for instance, I have like $800,000 in equity in a home paid off, right? And I maybe need 100,000 somewhere to do some renovations or whatever I need to do, whatever need I have, and then put on top of that another 200,000-300,000 as part of the reverse mortgage. Is that a possible scenario?
Yeah, absolutely. Ryan, go ahead.
Yeah, also, we actually have an example of that we'll show you in just a minute here, but
Okay,
it's almost very similar to that scenario. What's cool is you could absolutely get the cash that you need in that example. So say you needed 100,000 for home renovations or, whatever it is you wanted to do, but you can set that up as a line of credit, right? So think of like a HELOC, but with some additional features. Sure. Some of the key differences are, HELOC, obviously you have to make payments. So you have an interest only payment for 10 years, then it adjusts, and then your payment usually goes up or will go up. So you've got way more flexibility on the payment on that money that you're using. Second thing is it grows, which is probably one of the most unknown features. And I'll show you some math on this in a minute too, where you actually have a compounding growth of your line of credit, right? So you might say you get a $400,000 line in that example, that 400,000 available to you is going to grow each month. Whereas in a HELOC, you have to reapply, reappraise, requalify if you want more. And then probably most importantly, the difference between that and like a HELOC would be, I don't know if you had a HELOC in 2008, but you might know what happened to them. They went gone, right?
Exactly.
So,
the banks sent you a letter and said you no longer have a HELOC.
That's right. Yeah, which is usually not good. You hear people say, "My home is my nest egg. This is my emergency vehicle." Well, that's great and all until real estate goes down, and now it goes poof, and you no longer have access to that equity. So in this case, you get access. It has a compounding growth rate to what you can access, and it removes the risk of the downturn of real estate. Once it's in place, you've hedged out that risk. Real estate can go down. You can still access that credit line at the compounding rate. So to me, that's one of the great features to be able to eliminate that real estate risk.
Yeah, I was going to ask you that. All these products were great, right? When markets are going up 5-10% every year, but what happens if my home value, say for instance, I do let's take a scenario, and then we'll go into your presentation. I'll probably have more questions along that. So same scenario. I have an $800,000 house here, and I took out a reverse mortgage, cash out reverse mortgage, and $100,000 the balance. I have another $300,000 on the line, and then my house value just dropped 60%, let's say, and now it's only worth $300,000. What happens in that scenario?
So as long as you're living in the home, you still have access to that full credit line, right? Okay. So the line's in place as long as you, and if you and your spouse both did it together, the second person, as long as one of the two of you is still living in the home, you still have access to that line.
Oh, fantastic.
So you're good. Yeah, which is huge. Again, another thing a lot of people don't realize.
Well, fantastic. Well, Ryan, let's get to your presentation. We're at the half of the hour here, and I'm sure I'm going to have some follow-up questions, and Ruth will as well. So
I'm going to hide me and Susan so we can pull up.
Well, Ruth, if you hide yourself, we can't hear you. So actually, maybe that's what she's trying to do. So let's. You just tell her when to hit the next slide, and she'll move over. So take it away.
Cool. Yeah. So what we're doing here, this is just something that we put together I'll give you an overview of some of how this thing works, some of the mechanics, and then I just put together a few case studies that I think you might find interesting. And then again, you can ask questions along the way, however you want to take it.
Sure.
Really, this is around optimizing home financing. And what the easiest way to understand this is two things. One, it is just a loan. So a lot of the things that you know about a traditional loan are the same on the reverse structured loan, or in this case, what we call, we're going to mostly talk about the government insured reverse loan, which is technically called a home equity conversion mortgage, or you hear people say a HECM, HECM. So we'll talk a lot about that. But it does more than what a traditional loan can do. And so I like to say, it's more than just a loan. The same rules apply, but it has some additional things that does what nothing else can do. So go ahead, Ruth, if you want to click to the next slide there. So just some, who is this for? So if you're doing a purchase and you want to increase your purchasing power. So you mentioned earlier about, people from California or wherever coming to Las Vegas, being able to buy all cash. And that's a great option. But sometimes you don't want to use all your cash, or sometimes you may say, okay, I've got, $350,000 in cash available. And I go look at the homes that are out there and I think, well, these are great, but what if I could afford $450 or $500? And now, but I still don't want a payment. I don't want the debt service. I'm on fixed income. So you can actually increase your purchasing power. You can do a reverse purchase. And so the very simple math I use, this is loose, but I say, you know, take the cash that you have available, multiply it by 140%, and that could be pretty close to your purchasing power, right? So, you know, if I've got, you know, $400,000 in cash, I don't know what that is, call it 600 or something, a little more than 600 that I could purchase, probably a little less, probably about 550. So I can go get a place for 550 roughly. And now I can buy a house. So what I could get for 450 now opened the doors to what you could get instead of 400 for 550. So if there's, you know, real estate agents listening, think about the pool of homes at 400 versus the pool of homes at 550 and the opportunity that opens. And you can still get into that again, not have to make a payment as long as you're living in the home, which is kind of cool.
And it's good for those that it's a necessary tool right now, given all the offers that, you know, are coming in at the lower price ranges, and that extra 100,000, 140, 50,000 is a big difference maker.
Could make a really big difference. And, you know, we talk to builders a lot around, you know, using this as a tool where now you got additional cash for upgrades and things of that nature too. So really just opens the door to more purchasing power, which is, you know, what people want when they're buying a home. Good for both families as well as the agents. If you own a home and you have an existing loan, you know, rule of thumb, 50% or better equity position is roughly what'll work here. So a lot of opportunity there is, again, kind of roughly the math. It gets better than that as you age. You want to keep a cash available. So a lot of times, again, kind of same type of thing. We call it keep your powder dry, right? So I may be wanting to purchase, but I don't want to extract money from my investments. Or where we see this a lot is a lot of people's liquid assets are caught up in a retirement account. You may have an old 401k, and I think, hey, I could use that for down payment, but I pull 100,000 out of that. That becomes taxable income. I'm writing a check to the IRS for 30 grand. You net 70 to take out 100 to get 70 is not great math. So there's a lot of ideas where you can show how to hang on to some cash. Again, for real estate professionals looking that work with clients that have large down payments, this is definitely something that you'll want to understand. And the way I share this with a lot of the families that we design cases for are what you're going to get is options and flexibility, as well as a level of certainty. And to me, when you're approaching your retirement years, options are what you want. How do I get more flexibility, more optionality to how I manage my cash flow? These past 18 months, a lot of the deals that we've been doing have been people looking to create that flexibility, which is, what if I do lose my job? What if I don't, or am unable to make payments for the next 24 months? I don't want to be at risk. So let me set this up, give myself that flexibility. I may go back to making payments once things stabilize, but allows me to not take withdrawals from my investments if the stock market's down. I'm not having to realize those losses and allow that portfolio to recover. So there's some great math around that as well. So options and flexibility are big. All right, next slide, Ruth. All right, so some key concepts. This is just kind of the baseline parameters for this. So it's an FHA insured loan on a primary residence for people at least age 62. I'm not going to get a whole bunch of weeds on what all that means, other than it is insured. The importance of that insurance means if for any reason you put this in place, you never made a payment, the debt increased, we saw a downturn in real estate, all the bad things that could happen happened, and then you end up owing more than the home is worth, that insurance policy steps in and pays any deficiency. So neither you, your heirs, nor your estate are responsible for any debt beyond the value of the home. So that's the non-recourse feature, which is extremely important.
That is nice.
Also unique then, like in a short sale, you could sell short, but as you know, if you have that forgiveness and that deficiency, you probably know you get a 1099 at the end of the year, right?
You get a tax bill.
You get a tax bill. So yeah, all of a sudden you short sold for 100 grand, and now you got to pay the IRS another $30,000 at the end, right? So that's bad. So a little more flexibility there. There's a lot to that insurance that becomes important as you dig into these. As I mentioned, mortgage payments are optional, not required as often as you want to pay, as unoften, as much as you want to pay. Lots of flexibility there. Just like a traditional loan, you still pay your homeowner's insurance and property taxes, and keep it in decent condition like you would on any loan. So that's no different. So people say, what's the term? When does it due? You never have to make a payment as long as one of the two borrowers live in the home, assuming it's a that's a spouse, right? So as long as both of you live in the home, or if it's a single person, as long as that person's in the home, they don't ever have to make a payment. They can stay in the home. Once they move out, if they go to a facility or if they were to pass away, you essentially have up to 12 months in order to pay that off, or figure out, you can refinance it, you can sell the home. A lot of things you can do at that point, but you have, it's 3 months, and then you can continue to get extensions, usually up to about 12 months. So you got a fair amount of flexibility there as to how to figure out how you want to exit the loan if that becomes an issue down the road.
So there's 2 points I want to point out here, which is pretty powerful, which I didn't know about. Was one, say for instance, I take out, that this is why the 50% equity line or loan to value probably is important, because it gives you, the lender or the bank, the ability to absorb some market fluctuation. But say for instance, worst case scenario, again, 2008, what I'm hearing you say, let me correct me if I'm wrong here, Ryan, is that if my line is like, say for instance, I take out a reverse mortgage for $400,000, right? And again, the scenario I posed before, house value at the time I took it out was $800,000. I'm not making any payments at this point. I'm living in the house. I'm making 0 payments, right? And what happens is obviously my balance goes higher, obviously with the mortgage, and that's how it all works. And so if the market drops to 300,000, now my house is worth, for whatever reason, 300,000, I still, as long as I'm living in the house, do not have to make a mortgage payment. That's my first question. Correct. Right? Okay. Yes. My second question, which is key too, is I've lived a long life. Now I pass away. My heirs, obviously my mortgage balance is 400,000. The house is only 300. The estate only sells it for 300. You're telling me that we get to wash our hands away from this and just walk away. The family just walks away, gets rid of the house. The bank gets 300,000, and FHA, the government insurance, takes over the other 100,000 balance that I owe.
That's exactly right. And there's actually one step farther than that a lot of people also don't realize, which is that all happens. In addition to that, the heirs actually have the option to purchase the home at 95% of the then appraised value.
Wow. Okay.
Which is crazy to me, but that's another feature.
That is crazy. Okay.
It still steps in, pays the difference, and then they can still purchase the home at 95% of the appraised value.
Wow. So the family can buy the home for 200. And if it appraises for 300, I can buy it for 275, 280-ish thousand at that point.
Yep.
Wow. That's incredible. That's actually, I didn't know any of those details, because
so that's unique. It does things nothing else does. And it's crazy to me how often we have these conversations and how few people actually understand all this stuff. So there's a lot to it.
Right. No, that's great. That's great. So
cool. So the other thing, people ask a lot about, if I take money out, is it a taxable event? So there's, it's a loan, so there's no taxable event. It's not income taxable if you take money out. So you're fine there. I can't, what's the last one on there? Oh, available as you can get it out in lump sum. If you're doing a purchase, you can get it as a revolving line of credit. You could actually set up income streams for a lifetime of income if you want from it. You can set up a term of years. We see the term of years a lot for people that want to, in the planning world, we'll use this as a bridge to overcome Social Security, meaning if you take Social Security at 62, you have a discounted income that you get, right? So full retirement age is 66 and change. So if you take it early, you're going to get a discounted amount. Every year you don't take Social Security, you know what the growth rate is on that?
It's like 6-7% or something like that, right? 6-7%.
8%.
8%.
Yeah, it's 8. Yeah. So I always ask people, do you know anywhere you can get a government guaranteed 8% rate of return on an income stream? Nowhere. It doesn't exist except Social Security. So every year you don't take it. So if you can figure out a way to defer until 70, then you've got that 8% growth rate. So really just playing math, right? What's the cost of my loan versus is it less than 8%? And if it is, then most cases, there's some life expectancy stuff that comes into play. But for the most part, if you can figure out a way to defer Social Security, you end up better long-term. So there, we've used that as a term of year. So you might go in and say, okay, here's what my Social Security was. I'll put this in place from 62 to 70, bridge that gap, then flip on the Social Security and end up in a better financial situation.
Yeah. I mean, this is a great wealth transfer vehicle too, for people who don't want to tap into their investments for income. I mean, this is a great way for them to use their home equity, which is dead money that doesn't earn anything. You have it in there anyways. And if they can supplement their income fully from the reverse mortgage without having to tap into their investments, that they end up leaving a bigger nest egg for their families. Oh, this is great.
Yeah. So which is counterintuitive. A lot of people think, well, when you do this, the kids, is out in the home or whatever it is. Well, to your point, if you've got liquid assets, this is what we say, this is actually more powerful for more
Correct.
affluent families.
Absolutely.
It's always been discussed as a last resort need-based thing. It works there. But those that have assets is where it's really interesting, because you get 2 or 3 kids. I love that. How often, if you got 2 or 3 kids, how often do they agree on what to do with mom and dad's home?
Right. Exactly.
Never,
right.
Right. One wants to live in it. One wants to rent it. One wants to sell it. They never agree. And so what you really want from an estate wealth transfer standpoint, one of the most critical things you can have is liquidity, right? I need liquidity, which gives me options and flexibility to my children and my heirs. So now they can afford to make decisions. You may buy out your sibling. There's just having that cash available makes a huge difference to people at the end. So we can show how you maintain your liquidity in your investments using the equity if you need it, or kind of toggling back and forth between the two to create some far better outcomes.
Yeah. No. Fantastic. All right.
Cool. So we'll take you through some specific studies. So I've got 3 quick ones I'm going to show you here. One to be a family that's downsizing. They have a $450,000 home. They're going to downsize to one for $300,000. That's supposed to be not $300. My dad. And the second one will be increasing from a $350,000 home to a $500,000. And then the last one I'm going to show you is the reverse line of credit and how that might work for someone doing a refinance.
Okay.
So go ahead, Ruth. I'll take you to the next one here. So this here is pretty cool. So this is somebody that is 65 years old, and they're looking to downsize and purchase a home for $300,000. So on the left side there, it's a little hard to see the slide, but the left side, you have the without using the reverse purchase. On the right side, you'll see with the reverse purchase. So in this case, they have a home that's $450,000. They're going to sell the home. So we're going to assume after costs and expenses of selling, they may have to do a little renovation. They've got real estate agents and so forth. They're going to net $414,000. The home they're going to buy is going to be $300,000. Okay. So they go into, obviously have the cash to do it. So in the first scenario, they're not going to use the reverse. They're going to put down their $304,000, which is going to leave them with $110,000 left in there to invest or do whatever they want with it. I then looked at, okay, what does this look like 10 years down the road, assuming they can get a 6% somewhat conservative growth rate on that money. And that person has $196,000 in liquid cash after 10 years. Same example using the reverse for purchase. They sell the home for $450,000, net the same $414,000, purchase the home for $300,000. They're now going to finance $142,000 from the reverse mortgage. So they're going to come up, they're going to put about $175,000 down, finance the rest, never have to make a payment, right? So they'll end up, instead of $110,000, they maintain $240,000. Taking that same math and projecting that out 10 years at a 6% growth rate, they end up with just under $430,000 as opposed to $200,000. So they picked up a couple $100,000. Now, fair to say at the same point, they will, if they never make a payment, they'll have less equity than they would obviously in the all cash scenario. But when you start comparing the cost of the funds there versus the growth rate on what you've been able to get by having liquid cash, you're compounding, 200,000 instead of 100,000. The math works out really well for these people long term, and they've got liquidity.
Yeah, fantastic.
So that's one cool example. If you're downsizing, go ahead and go to the next one there, Ruth. And this one, went back to the beginning somehow. Oh no.
She's working on it. She's working on it.
Okay. I trust her. There we go. Okay. So this would be a person, again, 75 years old, and I just mixed up ages so people could see it a little differently. There it is. Increasing your purchase power. So this one is somebody that's 75 years old. And in their case, they're going to sell their home for $350,000, and they go shopping to try and find a home for $350,000, looking for what they want. They want to live closer to the kids. And they think, oh my gosh, to live in the neighborhood with them, it's got HOA, it's got all this stuff, it's a super nice place, but it's going to be $500,000. So now they're trying to figure out, do I pull money out of my investments or do I finance the property? So in this case, we're going to say, okay, they've got this $350,000. They're going to sell the home. They net $320,000, and they're looking to buy a place for $500,000. And the left column is using a traditional loan. So they've got $320,000 to put down. They're short to close $185,000. So either they're going to take that withdrawal from investments. Again, if they were to pull that from some type of a qualified investment or retirement account, they're going to have to pay tax. They probably have to pull out $210,000, $215,000 to get it. In this example, I said, well, let's just assume that they do a traditional loan in order to finance that difference. So they're going to be able to qualify for making payments. By the way, far easier to qualify payment-wise on the reverse. But let's assume they could qualify. They end up with a payment of just under $900 if they did a 30-year loan. So you fast forward, they're going to be paying about $9,000 a year in payments over the next 10 years. That'll cost them about $100,000 for that loan. Example 2, using the reverse purchase, same exact concept, but they've got the 320. They're going to do a $270,000 reverse mortgage, or reverse for purchase. And in that case, they're still going to have $35,000 left over in liquidity. And again, never have to make a payment over those terms of years. So you really start seeing where you can create some cash flow flexibility as well as access to liquidity. When we design financial plans for people, really what you're looking for is that balance of it's really a cash flow and liquidity game. Right. Retirement's cash flow, right? You mentioned earlier, we're taught to pay off our homes.
Correct.
Why? Right? You're taught to pay off your home because you don't want that high mortgage payment. You don't want the cash flow.
Right.
Yeah, when you're in your retirement years, you don't want that. And so to avoid, it's a cash flow equation. And so in this case, you're able to solve the cash flow equation while still living the life you want without having to go back. And, the worst thing in designing a plan that I ever had to do is go back and say, it's not going to work. You're either going to run out of money or you got to quit the golf membership and stop traveling.
Right.
People don't do that, right? That's behavioral modification. And unfortunately, people don't like that. When we can show you can get what you want, right? Have the cash flow you want and live the lifestyle you want, it starts becoming far more compelling.
Mm-hmm. And so there's no term end on these reverse mortgages is what you're telling me. So just as long as you're living in the house, I mean, if you're 62 and you happen to live to 102, no mortgage payment, you're good. Okay.
Yeah, you're good. So it's funny, I actually had a conversation a couple weeks ago, got a call from a CPA from a client that we'd done some work with. And her question was the same, what's the term on this loan? I don't know how to build this in and what to do. I'm like, so I had to sit down and break the whole thing down for how it worked. And then we'd actually ended up doing a whole bunch of really neat tax strategies with that family. They had refinanced. And so they refinanced a previous reverse mortgage. And in doing so, they hadn't made payments. So they had this big accumulated interest that had been there. So when we paid it off, it all became deductible in that year.
Oh, wow.
So it became this really cool strategy with them. We were able to claim that deduction, pull some money out of a retirement account without any penalty or any tax liability. So there's some, again, you start really getting the weeds. There's some cool stuff.
Yeah. Let's go.
So last one I'll show you here. Yeah. I'll take you through. I know we're going to get tight on time, but this last one is the line of credit. And I actually think this is probably one of the coolest things that is completely not understood. And this is it's probably easier to see in a graph. I just have numbers here. But so on the left side, this is a 65-year-old. They have a $750,000 home. So it's kind of close to your example of I've got an $800,000 home, pretty close.
Yeah, right.
And in this case, they owe $150,000. Okay, they're making payments on that loan of about $1,200 a month. It's been in place for a little while. And so the current value of the homes, and it will show you current and then what this looks like 10 years from now. So they have a home worth $750,000. We're able to lend them in this example $361,500. Okay, so that's a total credit line. So we're basically going to pay off their existing loan. In this case, we'll finance any expenses, so there's nothing out of pocket, and then give them a full line of credit for the $361,000.
Okay.
So they now owe $173,000. They got a line for $361,000, which leaves them, I can draw anytime I want, access to that $188,500. Okay. Net equity in their home is $577,000 in equity still available. If they pass away today, that obviously would go to the kids or whoever their estate is distributed. Immediately, they have a cash flow increase of a little over $14,000. They've limited to $1,200. So they have some decisions to make now with that $14,000 a year. Do I continue to make payments? Do I make interest-only payments? Do I reposition this to an investment? Do I buy long-term care insurance? What are some of their objectives? They immediately have optionality there. Here's what's interesting. In this particular example, the all-in interest rate here is call it 3%, right? So every month they don't make a payment, their loan balance will increase by roughly 3% divided by 12, right? And so it'll go up every single month, so that loan balance will increase. What people don't realize is that credit line is going to compound by the same amount. So if we have a 3% interest rate, it's going to be credited to that full line of 361. So if you think about it, you've got 3% compound on 173 is going to be a number. But what's more, that or the 3% of 361?
3% of 361.
Right. Yeah, that's not even a trick question, right? And so you start seeing a spread between these two lines. So that starts growing and you get access to more credit over time.
No cap.
So if you're
on the
no cap, it's going. Right. Even again, removing the risk of real estate downturn. So even if your real estate goes down. So in this example, here we have the home appreciating by 4%, right? May or may not happen. Kind of doesn't matter, but let's assume it does for the moment. So in 10 years, you've got a home worth 1.1. It's gone from 750 to 1.1, could happen. But your credit line, most importantly, has grown from 361 to 561. Mm-hmm. So you picked up $200,000 there. You've never made a payment on your loan, right? So at the same time, your loan balance has gone up if you hadn't made a payment. Now, keep in mind, you picked up $14,000 a year. You could have continued to make payments and keep your loan flat. And so your available credit has now gone up from 188 to nearly $300,000, right? So, and your home equity is still ahead. You were 577. Now you're at nearly 850. And again, your cash flow balance, just not counting if you had actually invested or got any compounded growth, you've picked up $144,000 over that time frame.
You got it. And there's no fine, super fine print in there that says that, if mortgage or home prices drop by 30%, the line can be cut off like a regular traditional.
So here's what comes. Here's why this works. So here's how the FHA does it, right? So essentially the borrower is going to be buying an insurance policy that is from the FHA to guarantee this. They're protecting the bank, the lender, as well as the client. Okay. And so what you're going to see, so the thing that people always ask, what are the fees and expenses in this? I always hear these are expensive. So the biggest difference between in this case, the government product. Now this is different if you go into non-government product. There are proprietary jumbo mortgages. Once you get into homes, you guys mentioned all the $1 million homes. When you start looking at places 1.1, 1.2, you'll probably want to look at more non-government backed stuff. Right. Slightly different rules there. But in the government one, they actually are going to buy an insurance policy. So your biggest difference between this and a traditional loan, you've probably heard of PMI. Yeah. Right. So mortgage insurance, right? PMI. And so same idea. It's MIP, mortgage insurance premium that you would pay. So they do have an insurance premium that they're going to pay to the FHA, which essentially is buying them this right to continue to have access to this credit line or income stream. Okay. And so that's the biggest fee difference that you'll see in this versus the other one. And so that's why this becomes, so it's, people say, oh, it's too good to be true. Not really. You're basically ensuring your access to that money. Mm-hmm. So it all kind of works out.
Because in my mind, for whatever reason, right, 750, my line goes up to 500. I owe at that time 400,000. So 900,000 is probably my fully balance if I just were to take the whole line, and say, for instance, the market drops 20% and I'm 89 years old and, my wife and I's 50th year anniversary is coming up and I want to do a blowout anniversary in Dubai for 500,000 and invite all my friends and family. That can be done. That's the scenario.
So it can. So it's fine. We actually just ran a scenario for a family where we projected the thing out 30 years and we tried to stress test every bad thing that could happen, right? So we put the line of credit in place at 62, let it grow. They took the cash. They were worried about in-home care, having a care facility, and they wanted to keep the home in the family. So in their case, we used the freed up cash flow to buy a life insurance policy with long-term care rider. So we wanted to cover the long-term care expense and then also wanted to have a death benefit available to the kids if they wanted to keep the home in the family. So we built it based on the projected future cost of debt on the property, right? Mm-hmm. And so did that. We modeled a downturn in the market because they were living off of their investments. And so when they had a downturn, instead of pulling and realizing those losses from their investments, they drew from the line of credit, right? So it allowed that portfolio to recover. Huge impact on their access to cash, massive impact. We then modeled the downturn in real estate. Right. So massive drop in real estate. We ended up him having to need in-home care. We used the line to cover his elimination period to get in-home care for the first 90 days. I mean, all these, they had to renovate the home, all these potential life things that could happen. And at the end, we found they had excess credit line of about $300,000 beyond the value of the home because of the real estate downturn.
All right.
So there we modeled the husband had passed away at this point, modeled the wife withdrawing that $300,000, gifting $100,000 to each of her kids. And so her thing was, I want to give it while I'm alive. So, giving is about oftentimes changing the hearts and minds of the giver as much as it is the recipient.
Absolutely.
So she wanted to experience the blessing of that gift. And so she gave during her lifetime. And so it showed them what the kids were able to do with that money, buy down payments on their own homes, and then what it looked like at the end. Again, they could come back. They had a huge accumulated tax deduction to get money out of their IRA at the end. Plus they had this tax-free death benefit from the insurance in order to be able to keep the home of the family.
No,
so
fantastic.
Cool sequence of, again, I know I'm getting a little bit weedy, but in the weeds, but there's just so many things that people don't realize. No,
absolutely. Absolutely. So for the sake of time here, let's bring Ruth back on where, that's a lot of information. And I learned quite a bit today, actually. So, thanks for coming on here. But Ruth, come back on. I do need to get going. My son actually has a soccer game today at 10:30.
I just said goodbye to my daughter. She just ran out to go to her soccer game. Right. She's like, bye.
So we didn't bring this slide on, but this is really good. Can you just quickly explain it?
Yeah, just real quick. So this one's interesting. This goes through, it's a matrix that shows a purchase price based on age. So this gives you an idea of what you might be able to access based on specific ages if you're looking to do a reverse purchase. So, it's kind of a cool matrix. Here's the key to think about, and Susan alluded to this earlier, which was the lending limit, the amount you can get is based on 3 factors. It's the home value, your age, and interest rates. Okay, so if you think about it, the FHA doesn't want these to go upside down because they're insuring the loan. Right. So they're going to loan you a reduced loan to value, assuming you're never going to make a payment and you're going to live to 100. Okay, so that's how they do their math. So the question becomes, are they going to lend you more or less if you're older? Well, they'll lend you more because you have fewer years for the debt to accumulate, right? So they'll lend you more if you're older. Same thing with interest rates, more or less in a low interest rate environment. They'll actually lend you more in a low interest rate environment because the debt will accrue more slowly. And so and then obviously they'll lend you more against a higher valued home. So I like to share with people, you can't control age. That one you can't, but you can kind of look at, where are we with real estate values and where are we with interest rates? Yeah. And most people would say we're at pretty high values, I think. I mean, we'll go up probably, but who knows? But we're at pretty comfortable real estate values. We're arguing at quite low interest rates. And so Susan mentioned, you're kind of in the perfect storm right now to maximize the opportunity. So it's interesting. And one last thing I'll share, then I'll just be quiet. I just did the math the other day. Some people say, well, I'm 64 right now. What if I wait a couple years so I can get more? Because I get more if I'm older. So I've always assumed this, but I hadn't run the math of comparing that versus do it today and let the credit line grow. Right. So my credit line is going to compound every year. So which increases faster, the HUD tables, so I get more when I'm older, or the compounded growth. And I always thought it would be close. It's not even close. The compounding growth is significantly higher than if you wait to get older. And that also assumes flat interest rate. If rates go up at all, then you're worse off potentially.
Wow.
So it's really, the math is really fascinating when you get into the weeds on these things. And I get a little excited and geeky about it, but
right. Well, Ruth, I have to get going, so you can end the show with the studies. Ryan, nice to meet you. Thanks for coming on. And if Susan's still on, thank you for coming on as well. And for everybody, I will see you next week. Ruth, end the show.
One other thing, we have a class this week. You can sign up at bee.vegas. It's Thursday, April the 15th from 2 to 5. 3 CE credits for agency, and it's called Do You Really Work for Your Client? Well, prove it. Again, go to bee.vegas. It's April 15th. That's Thursday from 2 to 5 at 8400 West Sahara. You can Zoom or come into the classroom. And everybody, thank you so much. And Susan and Ryan, what a fantastic show. Lots of people are going to see this. So congratulations on it. It was fantastic. Thank you.
Thank you, Ruth. Thanks for having us.
all of your time was well worth it, Ryan. And Susan, thank you so much for hanging in with us and putting it all together.
Great.
We love everybody. Thank you. Have a great
Thank you.
weekend. And
Thanks, Ruth.
see you
You
next
rock.
Bye-bye.